Good day and welcome to this, the first in our five-part series in an analysis of markets and economics and underlying portfolios to the end of June, as is for the half year. We trust that you're going to find this video and the other four insightful and will add some insight into how Korner Perspective has positioned particularly its local and offshore portfolios. All right, we have got quite a full agenda. Really what we're trying to do today is to discuss some of the big picture stuff, and that is really around macroeconomics and a few of the bigger drivers of asset markets. So starting off as one should, obviously the first thing to look at is politics. There's really been a lot happening over the last year or two. And there's probably far too much to mention. And as the slide would indicate, obviously, the Russian invasion of Ukraine continues to dominate, and that obviously is creating its own tensions, but then also quite a lot of tension economically, socially, politically between the US and China. But I think the big theme is what's illustrated in the next few slides, and that is what we call or refer to as the disappearing center. So firstly, if we look at the American political system, what we're seeing is, continual divide between presidency, Senate, and the House of Representatives, and really that, divided political order, but a very delicately balanced one, and one in which there seems to be very little political will to reach across the aisle, is really the perfect recipe, as we say at the bottom there, to get nothing done. All right, so I think one of the biggest things in global politics right now is the fact that the center seems to be disappearing. And if you look on the right-hand side of this slide, you'll see, you've got the AfD, which has obviously had a very strong performance in Germany. In Italy, of course, the Brotherhood there doing well. And even in Scandinavia, you've seen quite a big jump to the right. So obviously, we're talking here about the move to the right, but there's also in a lot of these nations, more polarization and a jump to the left, and that's really the problem. That what we would normally refer to as the pragmatic center politically, which is where negotiation happens and things are negotiated to get critical legislation through. That seems to be disappearing. And then on the left-hand side, as you can see there, we're talking about the fact that the polls are very strongly pointing to the fact that Labour is set to win the next general election and be the next party in power in the UK. And that in itself obviously causes some disruption. All right, a very quick slide just to talk about the growing divide between developed and developing economies. You've seen BRICS flexing its muscle and starting to become more prominent. Of course, another important variable here is the fact that everybody, Germany, France, the US, China, Russia, everybody courting Africa, obviously seeing the potential that the continent holds. And then what we're finding is obviously nations need to take policy positions, but there's a growing attitude that, pick your friends, and if you don't pick me, then we're enemies. And we feel that that's quite an infantile approach, and it can be quite damaging for a lot of people, in fact, for everyone. Something that probably doesn't get enough attention other than in ESG type of circles is the whole issue of climate change. And in June of 23, to not at least have a couple of slides and a brief discussion on climate change, I think would point to a naivety. Not so long ago, if you spoke climate change, you were considered to sort of be a tree hugger or a lunatic fringe. But I think there's enough evidence out there that climate change is real. Everything from rising temperatures, but really much more dramatic climate conditions. So many countries continue to get the same average rainfall, but they've got periods of extreme drought and then periods of flooding. And you've seen in the US, for example, in some of the breadbasket regions there, devastating droughts, some of the by far the worst, in fact, in living memory. And of course, increasingly warmer conditions, and we've seen in Europe, in China, in Japan, record highs. Yeah, so clearly there is evidence that climate change is real. Obviously, there are many, many critical ecosystems. I think from our point of view, climate change is probably net for many traditional economy kind of investments, probably net negative. It's going to probably divert or redirect spending. As we clean up the global economy, and particularly power generation and transport, it obviously is going to require a lot of investment. So the bottom line is there will be winners and there'll be a lot of losers. If you just think about agriculture, for example, there's a very high probability that a lot of farmers will not make it because of, a couple of bad crop years because of drought, for example, but others arguably will do well because we're probably moving into a more uncertain food environment. And of course, as is always the case, the poorest of the poor and the most vulnerable probably will be the most impacted, which is going to require a coordinated global effort. But I think the key thing for now is to say that climate change is real and it's going to hurt, for example, through devastation of infrastructure. And it's something we need to keep in the back of our minds as we craft investment strategies going forward. All right, then obviously, inflation targeting for much of the last decade was a dawdle. In fact, you would argue that central banks were trying their level best to fan a little bit of inflation to get to that sort of magical 2% figure. And here you can see all the heads of the various central banks looking a little bit perplexed and anxious as we move from inflation targeting being a dawdle to becoming somewhat of a nightmare. It largely started with the Russian invasion of Ukraine, although the seeds of inflation were sown before that. But what really put the cat amongst the pigeons and caused an initial spike in inflation and so the seeds then for second round was energy prices. As you can see here on the right-hand side, natural gas more than doubled in a few weeks. That hitting the European and the UK economies quite hard and consumers. But then equally on the left-hand side there, we've got Brent crude oil, and we saw what happened there. And of course, we're all very aware of what happened at the local pumps. So energy prices in large part started it, but it very quickly also had a very profound effect on other commodities such as the grains. And if you look there, for example, you saw the wheat price, bearing in mind that Russia and the Ukraine are combined represent almost 30% of global wheat production, caused a massive spike. And there on the right-hand side, you can see EU food inflation, got to almost 20% in a very, very short space of time. And although we've seen inflation moderate here, again, we've got the EU inflation chart. The reality is we're still sitting at levels well above what central banks would be targeting. And as this next slide would suggest, there's inflation in the system. You can see it, disposable income in the UK and in Europe, for example, but elsewhere in the world has been under quite a lot of pressure, and particularly skilled workers are not taking that anymore. And you can see that, the second round effects of inflation, for example, in wage inflation, is really starting to manifest itself. So I think the conclusion we would come to is that inflation is going to be off these sort of recent highs, but it's probably going to remain stubbornly above what all these central banks are targeting. So all of this leads us to a very simple conclusion that the easy money train has left the station, and it's probably not coming back for a while. Excuse me. The central banks obviously were forced to act. I think many of them very, very reluctantly, but when you've got inflation running at 8 or 10%, and your primary mandate is inflation targeting, you pretty much lose the option to look the other way. You can see there the Fed, the BOE moved quite quickly. In fact, the Bank of England moving a little bit faster than the Fed, but maybe in a slightly more measured pace. So the Fed started a little later, but moved a little bit more aggressively. ECB, as usual, playing catch up, and as is so accustomed, as we're so accustomed to, the Bank of Japan did absolutely nothing. All right. Also, if you look at the South African Reserve Bank, who has really been one of the most consistent in terms of policy and coherence, and not looking the other way, moved very quickly and very aggressively. In fact, as you can see there, the SARB moved well ahead of everybody else and has actually moved just as aggressively, even though it was off a higher base. And as you can see here, prime is at a 14-year high, and with inflation, with a more recent print at just under 6%, it would suggest to us that the SARB has actually moved from being sort of balanced to being quite restrictive with monetary policy. And our view was that the two last 50 basis point hikes, obviously, as we record this, the recent rate decision was to hold, but the previous two of 50 basis points we felt were overly aggressive considering where we were in the cycle and the trend of inflation. But bottom line is, monetary policy in South Africa we believe to be very tight. So the question then is, with inflation moderating and interest rates higher, what do real returns look like? And the amazing thing is, if you take the UK, for example, and we're just taking the administered rates here as the proxy for cash, you can see the UK yields in real terms. So in other words, yield less inflation, you're still sitting at negative 4%. Japan, Australia also very, very negative. Interestingly enough, the US is now slightly positive, and I think that's more a function of the fact that inflation has come off there quite aggressively, although the core number is obviously going to trail. But then the key message here is emerging markets such as South Africa, China are offering very, very handsome real returns relative to the negative yields in real terms that are being on offer elsewhere in the world. All right, then very quickly looking at confidence and growth, and the reason we're sort of shining a light on confidence is really because we're at a point in the global economy's history where people need to start taking a leap of faith, and you need to start penciling in where you think things are going. What we've got on this slide is the PMI figures for the US, the UK, China, and the EU. As you can see, all below that critical 50 mark, and quite worrying for both the US and the UK. Pretty low in the mid 40s. So that doesn't augur well for business confidence. And you would imagine that companies are going to continue to experience margin pressure, and with disposable income under pressure, it's going to be difficult for businesses to sort of claw back margin that has been sacrificed. Looking a little bit at South Africa, obviously business confidence here has been hammered by all these factors that are on the screen, and it's a little bit overwhelming, I think, for some people to look at everything that's going on. But this is what's baked into business confidence in South Africa, and the truth is that the last time we experienced lows like this was obviously in the depths of the COVID lockdowns, and before that was right at the end of the GFC. So that tells you just how bleak it is, and it's everything from dysfunctional SOEs through to corruption and the lack of the lack of policy certainty and excessive regulation, all weighing very, very heavily on South African business. The South Africa consumer is also in a very, very bleak space, and just looking earlier today at some property statistics at the lower end of the market, you're seeing that 40% of people looking to sell their properties, being their residential properties, are doing so because of financial pressure. And that is a combination of very, very high food inflation and obviously interest rates that have probably gone higher than most would have thought. But as you can see there, consumer confidence is really incredibly low and very brittle. All right, then just a quick word or two on growth and the growth outlook. I think the important thing is that global growth is going to moderate, particularly in developed economies. So we're talking here about the US and the EU area, and obviously the UK and Japan. The two graphs here are showing you some of the more recent data prints on the short term out of the US economy, and you can see growth has been pretty hard to come by. Obviously, as rates have tightened up and the environment has just become more competitive. But as you would see there, forecasts, which are those gray line and gray bars, still pointing to the fact that we are probably not looking at a recession according to the official forecasts, but we think that that actually is maybe a little bit too optimistic. A lot of people in the world, including many central banks, we believe, see recession as a four-letter word and it must be avoided at all costs. We see it as a natural part of the cycle. This obsession with avoiding downturns is in large part what gets economies and governments into trouble. And the reason we said we're not sure that recession will be avoided in the US is really highlighted by the very steeply negative or inverted yield curve, where short-term rates obviously significantly higher than long-term rates. And as you can see on this chart, the 10 and the 20 are quite similar, which is not supposed to happen. Yeah. So we think that the fixed income market may well be warning us that a recession is coming, but it's not necessarily dire. All right, then what we're talking about here is growth resembling dishwater, being pretty dull at best. As you can see, EU, Japan, the UK, all very, very anemic growth. And then China, which we'll just delve into a little bit deeper because it also tells a story about, COVID's long tail. It wasn't long ago that China was still in hard lockdowns with about 20% of the population until fairly recently in hard lockdowns, and that obviously had a massively dampening effect on GDP. As you can see from the middle of 2022, they never breached until quite recently off those low bases 5%. So I think Chinese GDP hurt badly by COVID. All right, as you can see here, Germany, these are the most recent GDP prints. You can see Germany, last number was negative, anemic growth out of the UK, France, etc. We believe that never has it been more important for China and the emerging market cluster generally, also India, quite importantly, who we believe is going to be playing a bigger role globally in economics. It's never been as important as now for those economies to fire. The more recent GDP print out of China was encouraging at 6.3% per annum, but we think that that's probably more as a result of the low base effects rather than it being pointing to a hugely positive economic environment. But bottom line is, even the recent economic prints were GDP growth prints were pretty dull. And then just on South Africa, it was in the previous slide, but if you look back over the last 10 years, as an emerging economy, being an exporter or producer of raw materials that go into iron ore, etc., into steel production, it's amazing that South Africa has been limping along with virtually no GDP growth. Obviously, more recently, it's looked a bit better because of the low base effects, in 20 and 21 and early 22, courtesy of COVID. But really, we have failed to capitalize on the incredible opportunities that were afforded us, given our mineral wealth and unique positioning in Africa. Obviously, bonds tracked inflation higher, and obviously tracked in administered rates. We're not going to go into this too much because in our asset class presentation, we'll go into this in a lot more detail. But needless to say, a lot of people who thought that we were going to be in a very low for longer kind of yield environment, that didn't quite pan out. And this really leads us to one of the big concerns that we have for the global economy, and that is around debt levels, and we talk government debt that's getting out of control. If you look out of the G7, 6 of those 7 G7 countries actually now have debt expressed as a percentage of GDP of 100% or more. And we'll look in a little while at the US situation, but as you can see, only Germany is sitting there with debt to GDP at 66%. Places like France and Canada the US all 100% or above. And of course, the continual outlier there is Japan with debt to GDP of over 260%. And the reason we say this is important is just around the aggregate level of debt. As you can see from just after the global financial crisis, let's take just around 2009 to 2020, US government debt went from circa $10 trillion to more recently it went through $32 trillion. And we're becoming increasingly concerned about the sustainability of that. And I think unless you watch this closely, you'd sort of have to ask yourself, where did this come from? How did debt to GDP get so out of hand so quickly? And I think if we take the American situation as an example, you can see, consistently negative budget deficits on a month-to-month basis. But then the big spike coming in COVID, where the American government decided to print checks and send it to taxpayers, that had the effect of significantly ramping up that debt. So it's the combination of stubbornly high budget deficits coupled with COVID stimulus. The question, though, is what is the relevance of this? What is the, why would one worry about aggregate debt? And I think this slide shows US interest payments expressed as a percentage of US government revenue. So effectively, it's a broad metric of how much of the budget is being spent on debt servicing. And as you can see there, the number's down at 12%, and that in spite of the high debt level is because the Fed, through its aggressive programs, managed to pull yields very, very low. So that had the effect of significantly reducing the cost of debt. But obviously, as time goes by, that debt is going to be refinanced at progressively higher rates. And we think that this interest payment as a percentage of budget or revenue, whatever you want to express it as, is going to increase significantly. And that is a source of concern. And the reason it is a concern is because obviously, as deficits remain stubborn, we think, at least on the short term, that the deficits are going to get even worse, and that more and more money is going to be allocated to interest servicing rather than other programs. And that obviously is going to lead to some form of austerity or cut in social programs. And obviously that is going to go down not very well. And if we just have a quick look at the South African story. Starting with government debt in South Africa, you can see there, the budget. South Africa, like the US, has been running a fairly consistent budget deficit. As you can see there, though, with COVID, obviously the budget deficit widened on the combination of falling revenue through taxes, for example, and investments in social programs to help alleviate the effects of COVID. In South Africa, the deficit trend is really concerning. Even if it remained steady as a percentage of GDP or revenue, the concern is that it's adding to an already fairly elevated debt position. And I think the key concern is that only government can solve this, and it starts, unfortunately, with a bloated public service and ongoing wage increases in that bloated public service that is, at or in excess of inflation. And of course, government is having to wade into other areas such as failing SOEs and municipalities, and all of that creates pressure. For us, and it's probably from an SA point of view, the thing that worries us the most is that tax revenue, we think, is becoming too concentrated in a few taxpayers. If you look, for example, at two resources companies being Amplats and Exxaro, you can see the charts here on their provision for tax, which is really SA. You can see a massive increase in the 2021 years for both of them. and 2022 for Exaro as well. But both those companies are forecast on, we just saw literally in the last day or so, the Amplet's profits decline. That doesn't augur well for tax receipts by SARS, which, if you think about inelasticity or fixed nature of expenditure, declining revenue from these mining giants really will put further pressure on an ever-shrinking tax base. The SA debt to GDP picture obviously has doubled from, let's say, 2010, where we were sitting at a very prudent 34.7% up to, call it, 71% in 2020. But as we've seen, Treasury trying to arrest that situation and slowly pulling it back. So, we're hoping it will get to 65 in the medium term and possibly even decline further. But that obviously depends heavily on government's ability to cut spending. All right, the balance of trade is important more from a currency point of view, but we thought this would be interesting because it will feed into some of the discussions around the asset classes. As you can see, South Africa, courtesy of phenomenal commodity prices, at the sort of early stages to the mid stages of the COVID lockdowns, results in a massive balance of trade surplus for South Africa. That more recently has shrunk almost to neutrality. We feel that commodity prices have probably reached the levels now where they're not going to decline too much further. So hopefully that will, together with some capital flows for a change, result in an improved current account. So really what we're saying is the global picture is murky at best. We feel on balance of arguments that growth is going to be hard to come by. It'll be driven mainly from emerging economies, China, India, and those economies that feed into those two nations. Our big concern, and we're not trying to be dramatic, is that government debt, we believe, is getting out of hand. And the laissez-faire attitude that both the Democrats and the Republicans seem to be approaching this with, in itself, is a source of concern. In South Africa, obviously, fairly inflexible from a budgeting point of view. We do think that our debt is still manageable, but it needs to be arrested. And then the last thought is, there's obviously a lot of negativity. We spoke about, business confidence and all the things that are weighing there. But we wanted a word of caution, which ironically is a positive word of caution. And that is that there is so much bad news and negativity baked into South Africa, whether you're talking the rand or asset markets, that if things come right, and they could come right simply because, we overestimated the negatives, and we see the contribution of, for example, the private sector, which continues to do quite well in what is a very unfriendly operating environment, as well as the informal economy, what's often referred to as the Kasi economy, still resilient. Those two factors, for example, together with possibly a bit of growth out of China, could very easily cause us to be very wrong-footed with too much negativity on the South African picture. That concludes our big picture review. From here, we suggest you move into the asset class review. We thank you very much for being with us, and we trust this was of value to you.